Hello and welcome all of you to this another edition of Navigate with HSBC. This is our podcast series which talks about various different facets of investment and investment strategy. But this series is slightly different because our guest today is a lady who is not only an investment fund manager, but is also somebody associated with the insurance industry. So that's a very lethal combination, of course. Please join me in welcoming Jyoti Vaswani, Chief Investment Officer of Canara HSBC Life.
Thank you so much, Shabir, for having me on your show.
As an investor, especially in a market like India, where there's so much of alpha and so much conversation about fund managers doing great and so on and so forth, why should an investor really care about a passive strategy?
So I think it's always also about the goals that the investors would have. Passive investment is now smart passive investment is what I would call it. So it's no longer just a passive investment, right? So it's smart passive investment. Now it depends on the goals of the investor. If an investor has a goal that he wants just stability and does not want volatility, then this kind of passive investment is more suitable for that investor. But if an investor wants, say, something like growth and he has a longer term horizon and he has a higher risk appetite, then he goes for the active fund. So typically, most investors will have a blend of both. They would have some part of their portfolio into active, funds, and they will also have something in the passive funds, which provides them, stability, and the active funds provide them the growth. So ideally, it is good to have a mix of both, which takes care of your growth requirement as well as your stability requirements.
Look, so again, I think this takes us back to the absolute fundamentals of investing, which is you should invest depending upon what your growth goals are, what your risk quotient is, and obviously eventually apply some degree of asset allocation to decide as to how you would want to spread out. So you're saying an investor should ideally do a combination of these two strategies, and depending upon what risk appetite the individual has, a certain portion allocated to a passive fund is a good idea. And I think another related question to this would be when you look at first-time investors, because we obviously as a bank, very often come across young people who just started their careers, and we onboard them and we give them a lot of experience. And one of the things that we do with them is do these sessions on financial planning, etc. And the first question they ask is, what should we do? Where should we invest? Would you suggest that, especially for a beginner, a passive investing strategy is a good place to start off?
I would believe so, because see, when somebody's starting their career, also they will have a lot of liabilities they would have taken because they're just starting off. It's not that they've built their wealth and they have, well settled in life. They're just starting off. So they would have a lot of EMIs and they'll have a lot of financial liabilities to take care of. And therefore, for them to invest very long term, will be difficult to put all the eggs in one basket. Will be difficult for them to put everything in the long term, because they will have short-term requirements as well. Because as you get married, you will have requirements. As you have kids, you will have requirements. As you are getting, you take more education, higher education, you will have requirements. So you need to have some passive investments there, which provides you some stability. And while you can also invest a part of your portfolio into active funds, which is the growth fund which you're building, the growth corpus that you're building, but that will be, a portion of your. So it can be a mix of both, I would say. I wouldn't suggest that, you should go completely for passive, but I think it should be a mix of both.
So, Jyoti, we spoke about how factor investing plays a role irrespective of whether you are a mature investor or you're a first-time investor. And I know we also spoke about how momentum or quality are various elements that you bring into passive investing. But I'll want you to sort of perhaps talk a bit more about this, because I think the general perception appears to be that when you talk about, factor investing, you're really talking about weighted indices and, those kind of things. And in fact, before we started this conversation, we were trying to struggle with what that phrase is really called, right? So tell us a bit about how different it is from just being another weighted index. Is it something more than that? And how does it also help the investor sort of gain from that strategy?
So it is much more than that, I would say. It's like I said, smart passive investing. So it is giving a there are various factors which are applied to a normal market weighted index. These factors could be, could vary depending upon what index it is, what strategy index it is. There are strategy indices which focus on value. So they pick up the, stocks which are, value, which fit the value investing theme. There are indices which will pick up the growth theme. There are indices which will pick up the momentum theme. There are indices which will pick up low volatility theme. So depending on what factor is applied to that particular, index, the returns would vary from what the underlying index is. So these are usually filtered from it's a subset of the larger index, and these factors will actually help to generate a little bit of alpha on the passive fund return. So while it will be different from the active fund return, but it will be more than what a passive fund can generate. So it's somewhere in between. So it's actually a blend of active and passive investment strategies, and it is ideal for all kinds of investors who have a longer term investment horizon, because these are usually, a little bit volatile. So, if somebody has a shorter term horizon, then they should go with large cap strategies with a twist. Okay. So it depends on what kind of investment horizon you have. There will be a strategy based index available for you.
And Jyoti, these indices and the performance is publicly available? Can everybody see that?
Absolutely. All right. It's publicly available and easily trackable.
And as a fund manager, when you sort of publish your performance, the customers can actually see as to how your fund, for example, is...
Absolutely. We will be publishing vis-a-vis our underlying benchmark, and it will be there in all our monthly fact sheets.
Great. We did speak about how different kind of investors can choose to invest in factor invest in funds, but I think a large part of our customers, when we go, because we do a lot of financial planning for our clients, one of the things that we do is even young people look at retirement planning and so on and so forth. Two extreme views, of course. One set of customers tend to be very fixed income oriented, absolutely. I mean, not absolutely, but at least largely assured returns and so on and so forth. The other ones, of course, have slightly longer view, would want to do equities. Sometimes are scared that they might run out of money because equities, if they don't do equities. So there, do you see factor investing again playing a part in their portfolio?
Absolutely, because passive, this kind of, factor investing is for people who have a longer term horizon. So if you're doing retirement planning, you want a mix of stability and growth, right? So these kind of funds will give you that ideal mix. They are stable as well because there is an element of passive investing in it, and they are, generating that alpha for you, which is also growth oriented. So without taking very unduly high risk, you are able to meet your goals, especially because you have a longer term investment horizon. For a shorter term investment horizon, it might become a little difficult because then there could be some volatility, considering that equity markets are a little volatile. But if you are looking to create wealth over the long term, then it is definitely fitting into your retirement planning as well.
Again, I think what you're touching upon is something fundamental. Say if you are a long-term investor, if you're an equity investor, you need to live with that volatility. Because in the long run, eventually, of course,
absolutely,
I expect to do better. And factor investing fits in very, very well into that.
You need to have that risk appetite to manage that volatility. If you have that capability to, take on volatility, because equity as an asset class will have some amount of volatility, as we are currently seeing the market, the way they are correcting. So it is not for the weak-hearted. It is for somebody who understands equity market, accepts that equity will play out as a long-term asset. Over the long term, equity as an asset class always outperforms. There is enough historical empirical evidence to show that.
Right.
So as long as you have belief in that, these kind of short-term market corrections, you should not be worried about.
Super interesting. I think when we started this conversation, Jyoti, when I was introducing you, I said that you are an investment professional, investment fund manager, but you are from an insurance company. So how does all this factor investing and all play a part in what you do with Canara HSBC Life?
So in insurance also, we have various kinds of products. We also offer term products and, on the traditional side, but we also offer unit-linked products. These are more market-linked products. They are more akin to how mutual fund schemes operate, but we give additional insurance cover on that. So when we offer these unit-linked products, we offer a variety of range of funds, by which we try to meet the requirements of our customers. So we also have a similar customer profile like a mutual fund would do. We have savvy investors. We have investors who are looking only for protection. We have investors who are looking for growth. We have people who are looking for creating wealth. So we also have to have a whole bouquet of funds for meeting these requirements of the customer.
Right.
So as a result of which, we try to keep innovating and try to get funds which will keep meeting the emerging requirements also of customers. And therefore, I think the passive investment strategy is one fund. So we will have that strategy as well. And now, as I said, a factor-based investing is another, a strategy which we are just introducing. And I think our customers are going to love it.
Thank you, Jyoti. And like we do every time, please look up to HSBC across the social media handles and obviously follow us at Navigate with HSBC for more interesting topics like this from here on. Thank you for watching us.
So we are starting with launching one fund. It's called the Nifty Multi-Cap Momentum Quality 50 Index. It's a blend of active and passive investing. So it gives you the best of both worlds. It is something which, is the future, and everyone should participate in this as well.